Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. You can also go to my website, which is jareddillianmoney.com. That's jareddillianmoney.com. There's a bunch of cool stuff there, including the Bond Masterclass, the Awesome Portfolio, and some other cool stuff. So go check it out at jareddillianmoney.com. So I want to talk about volatility, and we talk a lot about volatility on the show, but sort of obliquely. We say that the purpose of volatility is to make people make stupid decisions. As a friend of mine likes to say, volatility is an instrument of truth. So what is volatility? Volatility is how much an asset moves around. Some assets are more volatile than other assets. Bitcoin is probably the most volatile thing you'll ever own. AT&T is the stock doesn't move. It never moves. Now, volatility is not something you want. Volatility is undesirable. We don't like volatility. What we want is for our investments to grow in a straight line without volatility. We just want it to go up, kind of like a bank account back in the 1980s. You could have a bank account that yields 8% and it earns a little bit of interest every day and it goes up. That's really what we want our investments to do. We don't want volatility. Volatility is not fun. Although you would never know that people don't like volatility because everyone is investing in all this super volatile stuff. They're investing in Tesla, they're investing in SPACs, they're investing in biotech stocks, and they're investing in index funds. And the reason I bring up index funds is that whenever you invest in an index, you get the volatility of the index. Now, the investment holy grail is to have something that has a high return with low risk. A high return with low risk. That's what we're all trying to do. That is the holy grail of investing. And that is the genesis of the Awesome Portfolio. And the Awesome Portfolio does deliver a high return with low risk. That's why I keep yapping about it all the time. I can't stop talking about the Awesome Portfolio because it is the solution to your problems. Go to jareddillianmoney.com and check out the Awesome Portfolio. Now, it is possible to measure volatility with a yardstick. You can measure volatility and you can put a number on it. And we call this historical volatility. So you can take a stock, any stock, and look what it did in the last year. You look how much it moved on a day-to-day basis, and you can do some math, and you can compute the volatility and come up with a number. And that number is the historical volatility. So let's say the number is 20, okay? And what that means is, that means that a one standard deviation move in the price of the stock is 20% of the price of the stock. Now, in order to understand what I just said, you need to understand a little bit of statistics, okay? And one standard deviation is basically 67% of all occurrences. So 67% of the time, the stock is going to be between, if the stock is $100, it's going to be between 80 and 120, okay? So if a stock is 40, a one standard deviation move would be 8. That's 20%. Now, just by the way, 20 is approximately the volatility of the S&P 500. It's the volatility of the whole market. If you see a stock that has a volatility of 7, it hardly moves at all. That's like a municipal bond closed-end fund. That's like AT&T. If you see a stock that has a volatility of 80, it's an incredibly volatile stock. Peloton, I haven't looked at it, but my guess is that Peloton has a volatility of about 80, or Zoom, or Palantir, or stocks like this. Bitcoin has a volatility of about 200. It's incredibly volatile. Now, there's no place for you to look this up. unless you have some pretty sophisticated financial software. So I have Bloomberg, so there's a function that I can type in, and I can look up the historical volatility of any stock. But you can kind of see what the volatility is in the price of options, okay? Now, we don't talk about options a lot on this show. Options are very complicated, and options are one of these things you can't really learn about them by listening to the radio. You have to be able to see it. You have to see the diagrams. You have to see how this stuff works. So I don't want to go into a great deal of detail on options at this point in time, but we have to talk about it a little bit. So you have these things called call options. And if you buy a call option, you are betting that the price of the stock is going to go up. So let's say you have stock XYZ, and stock XYZ is trading at 40. And you buy the March 50 calls in XYZ. What you're doing is you're betting that the stock is going to be above 50 in March. Now, the price of options are determined by the market. It's determined by supply and demand, just like anything else. But there is a formula that you can use to determine the theoretical value of an option. And this formula is called Black-Scholes, the Black-Scholes option pricing model. And it was developed by these guys, Fisher, Black, and Myron Scholes. And they won the Nobel Prize in economics for the development of this option pricing model. Now, this option pricing model is an equation. It's a closed form equation, and it has 5 variables. Here are the 5 variables. Number 1, the price of the stock. Number 2, the strike price of the option. Number 3, interest rates. Number 4, the time to expiration. And number 5 is the volatility of the stock. So when we're doing this equation, we typically only know for the 5 variables. And actually, we know the price of the option, and we know the price of the stock, and we know the strike price, and we know the interest rates, and we know the time to expiration. But what we don't know is the volatility, because what we're talking about is future volatility. We do not know what volatility is going to be in the future. But what we can do is we can take the price that the option is trading at in the market, and we can take the equation and use that to solve for volatility. And then we have something called implied volatility. Implied volatility. So let's say you go to Yahoo Finance and you go to Palantir stock and you pull up the options. It will tell you the implied volatility of the options. It'll tell you the implied volatility of the options. And the implied volatility, in most cases, except for special situations, is going to be approximately equal to the historical volatility of the stock. Now, people who trade options, people who trade a portfolio of options, what they're trying to do is buy cheap options. They're trying to buy options where the implied volatility is lower than the historical volatility, and they're trying to sell expensive options where the implied volatility is above the historical volatility. But the implied volatility in most cases is going to be approximately equal to the historical volatility of the stock, and that gives you an idea of how volatile your stock is. And of course, Tesla is a very volatile stock. Now, remember, volatility is the enemy of your portfolio. And altogether now, the purpose of volatility is to make people make stupid decisions. So tune in next time when we talk about correlation, which is another mathematical concept. Actually, we can talk a little bit about correlation now. Correlation is the property of when stocks move together like a marching band. Now, when the market goes up, most stocks are up. Some of them are down. When the market goes down, most stocks are down. Some of them are up. If 2 stocks have a correlation of 1, what it means is that they move together in lockstep. They move exactly the same. If 2 stocks have a correlation of 0, they are uncorrelated. They have no relationship to each other. They just move randomly. And if 2 stocks have a correlation of -1, if one goes up, the other goes down, and vice versa. They're negatively correlated. Now, There aren't too many stocks that are negatively correlated these days, but negatively correlated stocks are extremely useful. The nice thing about having stocks that are uncorrelated is that they drastically reduce the volatility of the portfolio and improve the risk characteristics. By the way, you can measure the correlation of stocks with gold. The S&P 500 with gold. The correlation between stocks and gold is about 0.2. So they're mostly uncorrelated, and that's why gold is great for diversification benefits. Now, tech stocks are all going to be correlated. They all move together like a marching band. Energy stocks are all going to be correlated. They all move together like a marching band. But tech is not going to be correlated with energy, which is why it makes sense to be diversified across sectors. You want stocks from a bunch of different sectors. You don't want all tech stocks. You don't want all energy stocks. You want stocks from different sectors. Now, diversification is a complicated subject. Diversification keeps you from blowing yourself up, but it also prevents you from making supernormal returns. You diversify when you don't know what you are doing. If you do know what you are doing, you should have concentrated bets. The key here is that 99% of people have no idea what they are doing, and they suffer from overconfidence. They think they know what they're doing when they really don't. The awesome portfolio is for the 99% of us who have no idea what we're doing. It is the ultimate in diversification. You are diversifying across every asset class in the world. I'm Jared Dillian. This is The Jared Dillian Show.
Jared Dillian. Now you know a rich guy.